Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod. Alasdair is a senior fellow at the Gold Money Foundation, and his weekly articles written for Gold Money are posted at goldmoney.com, and I strongly suggest you go there, check out what Alasdair is doing, and other people as well, but Alasdair's articles are really worth reading and thinking about, and that's why we have him with us today to talk about what might happen in 2017 from his perspective. Thanks for joining me again, Alasdair, and Happy New Year to you.
That's my pleasure, and Happy New Year to you and all your listeners.
Thank you very much. I'd like to refer to your article titled Outlook for 2017, and then to the extent we have time also, Credit Cycles in Gold, another one you wrote, and still another one, Trump, Russia, and China. And so many things that you write every week that almost always I take a link to those articles and put them at miningstocks.com because I want people to read them. As you note, the stock market rose very sharply late in the year, especially after Trump won. There seems to be a great deal of optimism that has surrounded Trump's election, at least among some people. There seems to be this sense that if we only exercise more fiscal stimulus, that everything will be all right. There doesn't seem to be any concern about bigger amounts of debt. It seems as though people really believe that we can have our cake and eat it too, and life is going to just be honky-dory with Donald Trump. But you point out that may not necessarily be true. What might happen to us, Alasdair, when this honeymoon is over? Can you talk a little bit about your views for 2017 in light of what Donald Trump has facing him?
Yes, certainly. If you look back over the last 18 months or so, you'll see that bank credit has actually been expanding. Now, this tells us that the U.S. economy has been recovering and is no longer in recession. We now have a situation where, with that recovery having been over a year in gestation, we are probably moving towards a situation where there is capacity constraints, if you like, on much further growth. Nobody's talking about capacity constraints yet, and I can understand why, because it's the sort of thing you talk about when you actually see them. Yeah. Now, having said that, we've got this economy which has actually been developing quite nicely, courtesy of very low interest rates, courtesy of the banks, if you like, moving money off the Fed's balance sheet and using it to gear up to lend to the non-financial sector. And now we have President Trump coming in, and he's going to apply a business-like approach to things. He's going to cut taxes. He's going to cut the public spending. He's going to encourage infrastructure investment and all the rest of it. Now, all this is absolutely fine, but the problem is it's coming in at the stage of the cycle where interest rates are not only rising, but they're going to have to rise considerably more. Now, that to me is the big danger. We've seen in the bond market an early indication that this is becoming a danger. If you look at the way the price of the 30-year US Treasury has performed, it has actually fallen very, very sharply over the last 2 months. Admittedly, in recent days, it has, it has recovered a little bit. But that to me is a warning that with sick bond markets, if you're going to start introducing this fiscal stimulation on top of what we already have, then we're going to rapidly run into a situation where with capacity constraints, with supply blockages, prices are going to start rising a lot more sharply than anyone actually thinks is possible. So this is a dangerous time. You referred to my article also on credit cycles.
Credits, you're right.
And what is very interesting, and there was an absolute genius in the London gilt market back in the 1960s called Gordon Pepper. And he was fascinated to discover that the banks almost always lost money when they dealt in the gilt market. And basically what happened was when they had spare capacity on their balance sheet because there was a recession and they were keen not to lend any more money, they associated bank lending with risk, they would park their spare liquidity in short-term gilts. And these are gilts of up to 5 years maturity. Inevitably, when they did that, they were buying at the top of the market. When they felt confident enough to lend because there was an economic recovery and there might have been some takeovers, there's a bit of rationalization, all this sort of stuff that gets the financial community involved again with the basic economy, the banks would have to sell their gilts in order to create the liquidity to lend to corporations. And guess what? By then, of course, the market was looking towards rising interest rates, trying to discount them. It was looking at rising inflation, price inflation, and trying to discount that. So prices had fallen. And this was the reason that Gordon Pepper discovered that the banks always lost money when they were dealing in the gilt market. Now, underlying this, I think, is another aspect which I'd like to draw to your attention, and that is that when the basic economy starts recovering, there comes a point where money starts being sucked out of the financial sector and moved into the non-financial sector. And if the government is increasing its fiscal deficit, that money also goes into government as well. So what you have is a flow of money out of financials into government and real things. Now, that flow of money coming out is what drives prices. You will find that bond prices start falling, equity prices start falling. And the irony in all this is that when the equity prices start falling, you think, well, this is ridiculous because the outlook for equities has improved immensely. You know, business is good and all the rest of it. And brokers are saying that, forward PE ratios are falling. This is all very, very encouraging. But the reality of the situation is it's not that drives the prices, but the money flowing out of these investments being redirected into the basic economy. That is what drives the prices down. So I think here we're going into 2017, and I think we're on the edge, if you like, of that development. So it is a fascinating time. And this development was very important back in the late 60s and particularly in the 1970s, which, of course, was the decade when inflation eventually peaked at almost hyperinflation levels.
Mm-hmm. Indeed, it did. So what we could see here is improving fundamentals for buying stocks, but stocks could continue to go down. We could see improving fundamentals for owning bonds as the rates go up, and yet they could continue to go down. That is, rates could continue to rise and bond prices could continue to drop for some time. Is that what you're seeing, possibly?
Precisely that. Now, how long this happens, of course, we don't know at this stage. There are other considerations. There is significant banking risk within the European Union, as we've seen with the Italian situation. And it is quite possible that we get a crisis there which interrupts any cyclical considerations. I think also that the way China is developing her economy, she is beginning to spend massive amounts of money on commodities. We're talking about base metals and the raw materials, if you like, that industrialization generally requires. And China's spending has already driven up the prices of base metals and those raw materials through 2016. That was just a question of stockpiling. She is now going to begin to use her stocks of base metals and industrial raw materials to develop her own economy, to get away, if you like, from the reliance on U.S. Imports. Her exports to the United States. To the U.S.,
yes. Uh-huh.
Yeah. So we have a situation really where commodity prices are being driven upwards very sharply, and this is completely consistent with the end game, if you like, in the credit and business cycle. This is what we always see at the end of the cycle. There is demand for these raw materials, and guess what? The prices then start rising. prices for manufactured goods on the street start rising, people begin to realize that prices are rising, and therefore they change their preference away from holding money into holding goods and buying services before they really need them. This, in a sense, is the thing that the Keynesians want to stimulate. But the problem with it is that once stimulated, it is completely beyond anyone's control without raising interest rates to a high enough level to defuse all demand, which, of course, is the credit cycle of stimulate and then raise rates to, when inflation gets out of control and they end up crashing the market and then trying to stop it crashing by dropping interest rates quickly again, rather like in the financial crisis that we saw back in 2007, 8, 9. So the situation could well be short-circuited, if you like, by the instability in the whole system. And there is another point I'd like to make, Jay, and that is when it comes to how far interest rates can be raised by the Fed before triggering the next financial crisis. In my estimation, that level is probably in the region of a Fed funds rate of 2.5%.
Only.
Now that's nothing. Absolutely, only. This is a very, very important point. The reason why this is so is since the last crisis, at the time of the Lehman collapse, there has been a very rapid accumulation of debt in both the public and the private sectors. The low interest rates have just encouraged corporations to borrow to enhance their earnings that way, rather than by improving their trade, their products and trading. Rather than investing in business, they've just bought back shares. At the same time, private individuals have continued to spend. I mean, they've had nothing in the way of pay rises. If you talk about ordinary people, the ordinary guy on Main Street, he's actually in pretty poor shape. And the only way he's managed to make ends meet is to continue to borrow and borrow and borrow. And if he's lucky enough to own a house, he's probably remortgaged it a couple of times. So you can see the level of debt has accumulated, and it is that will topple over when interest rates rise, and when they rise to as little as 2.5%. It is that weight of debt that is the big, big threat, in my mind, to how far this economy can go under President Trump.
All right, Alasdair, then what I can see, if that's right, is that the Fed is going to have to try to continue to pump money into the system to suppress those interest rates. It's incredible to me. My first mortgage was a 17.5% mortgage. That was as a result of Volcker slamming on the brakes, or at least taking his foot off the gas pedal, back in the in the late 70s, 1980 actually. And we saw, as you said, he broke the back of inflation, and we had a horrendous crash in the equity markets and the bond markets, and then that set the stage though for some good years ahead of us, quite a few good years actually. But what do you see then that the Fed will try to continue to put gasoline on the fire, as it were, or to supply liquidity into the system to try to suppress the interest rates so that they can avoid this sort of a cataclysmic banking crisis? Or do you think that they'll perhaps not be successful? I mean, it seems to me on the long end of the yield curve, we're seeing the T-bond in the U.S. rise dramatically. We've seen, interest rates in Japan and elsewhere. Italy, of course, a very sick situation there. But is it in control of the Fed, I guess, is my question. And what do you think the outcome will be? And how long do you think it will go before we reach that 2.5%? You're talking Fed funds rates, I guess, right?
Yes, I'm talking Fed funds rate, because that is the control that the Fed has on the bank's reserves. That is what they pay the banks to keep the reserves, if you like, on the Fed's balance sheet. So to stop those reserves being moved out and then geared up, so that bank credit is issued on the back of every dollar to the tune of $10, $12, whatever the gearing they can achieve, the Fed is going to want to try and control that process. And so this is entirely consistent, I think, with the Fed's stated objective of raising interest rates over the course of 2017 in 3 or 4 steps. Now, what we don't know, Jay, is what the Fed's analysis of the debt situation is. Have they come up with the same sort of level that I have come up with, and that is a Fed funds rate of 2.5% could be enough to collapse the whole system? I don't know. I don't know that they have thought that through. I would guess that what they will do is they will raise it as they think is necessary, because they need to normalize rates. That is absolutely clear. Going back to what I said earlier, the expansion of bank credit tells us that the U.S. economy is actually performing quite well. It is no longer appropriate to have suppressed interest rates. So they need to normalize it, and they'll try and normalize it gradually in a number of baby steps. But what we don't know is, have they actually thought how far they can go along there in that direction before they create difficulties for themselves with bad debts beginning to hit the bank's balance sheets? My guess is that the way they would approach it is, rather than think of a level in the way that I have just described, they would probably suck it and see, raise the rates another quarter, leave it for a couple of months, see what happens. If there is still demand for money, if reserves are still coming off the Fed's balance sheet and going back into the into the banking system, the commercial banking system, raise the interest rates another 0.25%. I think that's going to be their approach. And unwittingly, I think when the Fed funds rate gets to 2.5%, and remember that on a rise like that, you will find that the lower quality debt, the cost of refinancing that won't just rise by 2%, it will probably rise by 5 or 6% or 7 or 8%. So the risky loans on a relatively small rise in the Fed funds rate actually become destabilized a lot earlier than you would think. And there is, of course, another aspect to this, and that is the Fed is going to be looking at the way price inflation develops, and they will see, because of the raw materials and the industrial commodity complex, as it were, all those prices feeding through, they will see that the combination of that and the fiscal stimulation that President Trump applies to the U.S. economy, at that stage they'll start thinking, hold on a minute, it does look like inflation is going up to over 4%. Now, that being the case, we better do something about this and raise interest rates a bit more quickly. And I think this is going to be the big tussle, if you like, in 2017.
Do you think we'll get to that point in 2017, Alasdair?
We could easily. I would normally say that this sort of process would last a good 18 months, maybe a bit longer. But because of the dynamics of the situation, and plus the likelihood that the political and economic developments in Europe could have a major global effect on fiat currencies, I would not really be all that confident about saying that this is going to last a full 2 years. We could well have a crisis this year if things start developing a little more rapidly than people expect.
All right, let's take a look then at what that might mean for the markets. Let's take a look. I guess what you're saying is you're bearish then on stocks and bonds, at least to start with, the start of the year until we reach that point that you're talking about, that critical 2.5% on the Fed funds rate. That's pretty consistent with Michael Oliver's technical views that he expressed earlier in the show. So bearish on stocks and bonds, I take it, at least for now, in the early part or through this year. What about commodities? And bullish, I guess, right? And the same for precious metals.
Yes, commodities bullish. The way I would rather people looked at this is not so much the commodity prices rising, though there will be demand for these commodities. As I said, China is more or less cornering the global market in these things to satisfy its current 5-year and the next 5-year plan. But the other way I would look at it is that actually the purchasing power of paper currencies is going down. And that, I think, is key. That's a key part of the understanding of what's going on.
All right. You mentioned briefly the threat to the banking system. I was talking to a senior executive of a major financial institution here in New York over the weekend, and he's pretty confident right now that at least the American banks are in pretty good shape. Their equity positions are strong, quite strong by historical standards, according to him anyway. Italy, not so much, he admits. But clearly there does seem to be, there's talks in now, it's actually written into policy, I believe, bail-ins. So the next time there's a financial crisis, they're going to start to take money from depositors. And so people should be thinking about, I think they should be thinking about getting their money out of the banking system to the extent they're able to, or at least to a great extent, and buy gold. And I know that you're involved with gold money. With a couple of minutes left, could you talk to our listeners a little bit about the products that gold money has that people might avail themselves to protect themselves against the potential of losses through the banking system?
Yes, sure. Very, very simply, we have set up gold money so that it can be used as money to replace the fiat currencies when the fiat currencies go down the tubes. And we run what we call the personal account, which is transactions. You can use them with a preloaded card, which unfortunately has to preload into fiat currency. But
sure.
Basically, you keep the bulk of your deposit, as it were, in gold, and just load your card as you need it. And incidentally, you own the deposit. This is fundamentally different from having a deposit in a bank. You actually own the gold deposit, and you can tell us which vault you want that deposit to be in. We've also got a business line which basically allows businesses to run their accounts in gold and to be paid in gold. And there are quite a number of different areas where that is of interest. The mines, for example, who are mining gold, their liabilities, if you like, in terms of their balance sheet, should match the gold price. So as much as possible, I can see that they will be moving in the direction of using gold as their fundamental unit of account. Mm-hmm. And then we've got the wealth side. And the wealth side basically is a facility. It's the old gold money side, as it were, the original gold money that was set up by James Turk. And there you can accumulate for your own account. Again, it's your property stored in a vault of your choosing. And you can have it delivered to you if you want. Obviously, the delivery charges. But basically, that's gold, silver, platinum, and palladium, so that you've got the choice of the four precious metals.
We're going to have to leave it go at that. Alasdair, I want to thank you very much for being with us. Happy New Year to you, and we'll look to do it again sometime soon.